Good morning. It is an absolute pleasure to be here with you all today. And so I want to thank the Money Show for having me, and thank you all for being here. So let me start by saying that we always formulate our outlook for the new year back in October, and we put it out in November. So of course we knew there were going to be tons of variables, so many unknowns. And I wanted to just preface what I go through today with that understanding that we laid out a base case. We also laid out an upside and downside scenario. And then, of course, the key is that we also articulated some swing factors. What would happen, for example, in a Trump administration? What kind of policies we'd see, and how that could impact our expectations, our base case. Also, what the Fed could do and how that might impact what happens in 2025. So let me take you through this. And let me start with just this summary page. And this lays out our macro views, our market views, and our risks. And it's quite simple. Our expectation is that as we start the year, the U.S. economy slows a bit, but it soon re-accelerates, and that's important. We see continued central bank easing. But when I talk about central bank easing, I'm talking about many central banks around the world. They're going at different paces because they each have different factors impacting their respective economies. But the overall environment is one of monetary policy easing. Although we're probably going to see far less from the Fed, and I'll go into that in a minute. And then finally, that we are going to see markets react to this re-acceleration. And that's really our base case, is that we see positive performance from equities. And that's equities globally. And I'll talk a little bit about the different catalysts for the different regions. That we're likely to see fixed income perform well because yields are high. And so we'll want to be diversified there, but there are opportunities. And finally, alternatives make sense as well in terms of diversifying a portfolio, smoothing out the volatility. And in particular, we're calling out emerging markets because we think there are going to be significant differences among emerging markets in 2025, which I'll get into. Now, that is our base case, but there's certainly an upside scenario and a downside scenario. The downside scenario is that all that aggressive Fed tightening catches up, and that we actually could have growth more negatively impacted. And that, of course, would create a far more risk-off environment for 2025. I think that's very unlikely, but obviously we want to look at any kind of signals, any market indicators that suggest there are canaries in the coal mine. There is that upside scenario as well, and that is that everything goes according to plan, but faster and better. So the growth reacceleration is stronger, that disinflation occurs more quickly, and so the Fed can ease more. Now, that is more likely than the downside scenario, but I think that when it comes to the Fed being able to ease more, that's probably the biggest question mark. And that takes me to the swing factors. So we articulated 4 swing factors. The first is that trade, the potential for tariff wars, as well as other issues, create more geopolitical risks. So there's more uncertainty, and I'll get into more of that in a minute. China policy stimulus could be a positive for China equities, and we'll talk more about that. Another swing factor is a resurgence in inflation and what that could do. And that's why we're even hearing strategists talk about the potential for a Fed hike this year. So we'll want to explore that because that could be impactful. And then finally, fiscal pressures have an impact. They have an impact on, for example, the 10-year yield. We could see bond vigilantes emerge if there's not enough confidence in the level of spending that we get that fiscal deficit down. But then there's also that other issue, which is that if we have enough of a reduction in fiscal spending, that can create growth headwinds. They can be temporary, but they can be significant. So let me start with the smooth landing. Our thesis is that we're going to continue to see an improvement in real wages because disinflation will continue at the same time we see some healthy wage growth. And that, in fact, what we've seen thus far is a global economy and a U.S. economy that has been quite resilient. In fact, if we were to look at PMIs, and in the chart on your right, you see the global PMI, the composite for the global economy. And in fact, the PMI came into contraction territory as tightening got quite aggressive, but it has since rebounded. And so we have PMIs in expansion territory globally. We have it in expansion territory in the US. And I think that's an important point to note. We've seen a very, very resilient US economy and to a certain extent a resilient global economy. So the second point is that we have an accommodative monetary policy environment and that continues. Well, why does that continue? Because it's necessitated. In fact, even in the US, despite the strength of the economy, you can make a very strong argument that the Fed needs to keep cutting. And I'll point to one key issue, which is the spread between core PCE, keep in mind that is the Fed's preferred gauge of inflation, and where the Fed funds rate is. This past summer, it was at its biggest spread since 2007. Never a year you want to compare yourself to. And that argues that monetary policy is too restrictive. We've heard Jay Powell say that. So I think once they're comfortable that we're not in any kind of resurgence of inflation environment, we'll see continued Fed easing. That is my base case. And I think we could see Fed easing as soon as late in the second quarter. It is true outside the US that there are many economies that need more easing, like the Eurozone. I think we'll see a similar level of easing, a bit more coming from the UK than what we're going to see in the US. I think we're going to see continued easing in Canada. So there are going to be a lot of central banks easing that creates an overall environment of monetary policy accommodation. And I think that's important in terms of supporting the global economy. Now, after the landing, what happens? We think we see that resurgence in growth, that it is strong, and that it's not just occurring in the US, it's occurring in other economies as well. So 2025 should shape up to be, I think, a positive year for global growth, for US growth. Now, of course, the question becomes, what happens with investments in this environment? What asset classes benefit the most? And what we know from past cycles of Fed easing is that when the Fed begins to pause, that is when risk assets start to perform better. So we see stocks perform well. We see high yield bonds perform well. We typically see corporate bonds perform well. It's an environment in which investors are more comfortable and less concerned about valuations. And so typically that's an environment that is supportive of risk assets. And so that's what we would anticipate in the US, and that's actually what we would anticipate globally. You can see when the Fed pauses and when it starts to cut, that's also positive for emerging markets. And I would actually focus in specifically on the mid-1990s, because I think while history doesn't repeat itself, it often rhymes. And what we saw in the mid-1990s is a Fed that hiked aggressively, not as much as the Fed this time, but it hiked aggressively. What we saw was that was the last time the Fed was able to hike and avoid a recession until now. And when the Fed paused and started to ease, even though it was very modest easing, we saw strong performance from US equities. We saw strong performance from international equities. The one exception was emerging markets equities. If you were to look at the MSCI Emerging Markets Index, you would be disappointed for the first 6 months after the Fed started to ease. But I would say that was very idiosyncratic and had to do with the Mexican peso crisis. So in general, that was the environment we're in. And I think there are a lot of analogies between today and then. Back then, we were also looking out on a very significant amount of investment in technological innovation. Keep in mind that we had Y2K coming up. We had a lot of excitement about the internet, and companies were spending a lot to create websites, to upgrade their technology. Not very different than where we are today, with a lot of spending going on for AI and a lot of opportunities for companies to adopt AI and make their operations more efficient. In the late 1990s, that led to a productivity boom, and I think that could very well be the case this time as well. I also think what we typically see is that lower rates encourage an environment that is supportive of smaller cap equities and cyclical equities. And you can see it in this chart, where we see what the impact of a steepening yield curve has. And the lowering of rates tends to be positive. So I would anticipate we could see a rotation this year, that we could see participation of mid caps that's better than it has been, smaller caps, and of course that rotation to cyclicals. That would also make sense if you anticipate a resurgence in growth, because that would be a discounting of that. The most cyclically sensitive, so the smaller caps and the cyclicals, they are likely to perform better in this environment. We know that from history. Now, in terms of fixed income, I think there's a lot of opportunity there, but there are also some pitfalls, because we don't exactly know where the 10-year is going to go. And there could very well be a scenario where the 10-year yield goes up from here, and that can be punishing to some areas of the fixed income space. So I think it's important to have exposure from bank loans all the way up to high yield, but recognize that that diversification is very important because we can have some volatility there. We don't exactly know where the 10-year yield is going to go, and it could very well move in a range. I don't think it will get to that psychologically disturbing 5% level, but I do think it's something that we need to worry about in terms of moving from 4.2 to 4.8, 4.85 could very well be a possibility. Now, there have been a lot of question marks around the dollar and what happens to the dollar this year. And generally, the rule of thumb with the dollar, and really currencies in general, is that the strength of the dollar, or the weakness of the dollar, is dictated by growth differentials and interest rate differentials. And also add in, for the dollar, rather than other currencies, there is that premium for being a safe haven asset class. So in this environment, what we would anticipate is a pickup in growth. That should be a positive for dollar strength. And we also anticipate that the Fed is going to be less accommodative than other central banks. So that in general suggests a stronger dollar, but with a few exceptions. I would point out Japan. The Bank of Japan is actually hiking. It is normalizing. And so I think that is the one currency where we could see the yen stronger or comparable to the dollar this year. The other could very well be the British pound, for somewhat similar reasons, in that the Bank of England may be have a very similar central bank policy this year, a very similar monetary policy this year. And in fact, let's talk about Japan for a minute. It's also an economy that is recovering. We have seen some structural improvements, really a result of Abenomics. And so that is an area of opportunity, I would argue, this year, although we've already seen a significant run-up in Japanese equities. But the fact that the central bank continues to hike ever so slowly suggests there's a normalizing of the economy, and it's finally comfortable doing that after so many years in zero interest rate land. Now, emerging markets in general, I don't think we can treat them as one size fits all. First of all, we have tariff policies coming from the Trump administration that are going to impact some of these economies and not others. So this is a time, I believe, to be an active manager when it comes to emerging markets, and really look for the winners versus the losers. And for example, if you're an oil exporting emerging market economy, you might face some headwinds if we see a significant increase in oil production, just as an example. But there are other economies, some of the Asia EM countries, that could very well benefit from a move to increase the number of factories outside of China, or replace factories within China with factories outside of China. So think of the ASEAN countries, think of, for example, India could very well be beneficiaries, although I would say Indian equities are very highly valued. And there's also potential for real estate. We know that inflection points in real estate prices can come when we see rates being cut. And so this could be a supportive environment for real estate. Of course, that's another area to be active and to be very selective, because we don't have rates down in a very good place right now. So in summary, the base case is that we're likely to see opportunities for equities. Developed market equities are likely to perform well this year. I also think there are going to be opportunities in EM, but we want to be selective there. Within fixed income, we want to run the gamut from zero duration to longer duration. Again, diversification is important when you don't know where the 10-year yield is going to go. And then, of course, adding in alternatives. The downside scenario is a risk-off scenario. So the commodity you'd favor in that environment is likely to be gold. That's where we're going to see a flight to perceived safe haven asset classes like the US dollar and the Japanese yen when we think about currencies. And that's where we're likely to see, again, a risk-off environment where there's a flight to perceived safety of US equities. Moving out on the spectrum, that upside scenario is a hyper version of risk on. So an overweighting of emerging markets, but again, being selective in this environment. And again, equities in general performing well. So let's talk about the swing factors for a moment. Tariffs. What I think is important to recognize about tariffs is we do have a playbook. We saw in the first Trump administration they were applied. And if we go back and look at the Federal Reserve Beige Book, what we see is that, I'm going to talk really loud until my microphone comes back on. I don't think I touched anything. What we have from the first Trump administration is that there was an impact, but it was short term. What we saw was that there were spending plans put on hold, hiring plans put on hold. If we look at the Federal Reserve Beige Book, prices increased, but it was temporary. And once the tariff wars were, for the most part, technically over, markets resumed their climb after having a small sell-off. And we saw, of course, spending plans resume, hiring plans resume. So I would anticipate this is somewhat similar this time around. All we can base it on is what we know about history and what we saw in the first Trump administration. And there could be some benefits. I think the administration is taking a page from the Reagan playbook in terms of trying to create more onshore jobs. And so you may recall Reagan was a very big believer in free trade, but he somehow was able to get both Japan and Germany to agree to voluntary export controls. That might be an oxymoron, but they limited the amount of cars that came into the United States, and as a result, built factories in the US that exist to this day and employ many Americans. So I suspect that's kind of the strategy, that tariffs are a tool, a means to an end as opposed to an end. Now, swing factor 2, China stimulus could reinvigorate growth. We envisioned the stimulus that was announced last fall as being very supportive. It could have been done at least partially in anticipation of tariffs being applied, but for whatever the reason, it certainly has been a positive for China equities. And then, of course, we also got the news a few weeks ago about DeepSeek and its advanced technologies. And that could very well be causing a re-rating in China equities in general. So I think because valuations are so low there, sentiment has been negative for 4+ years, we could see a pop there even if there are significant tariffs. Thus far, we've only seen those 10% tariffs applied. So in my opinion, there's certainly potential in China equities this year. We just want to be careful and selective there. Swing factor 3, inflation could return. Why do we say that? Well, if you do see an economy that recovers, sometimes it can go hand in hand with inflation. And in fact, really since September, we've gotten some market indicators suggesting that inflation is increasing or is likely to increase. So if we were to look at the 5-year break-even, that spread between the tips and Treasury yields, that tends to be a proxy for expected inflation. That has gone from 1.88% on September 6th, when President Trump was climbing in the polls or beginning to climb in the polls, to last Friday, it was up to about 2.62%. So a significant climb. And so there is definitely that potential. We're also seeing it in the Michigan Survey of Consumers, a big jump in inflation expectations. Inflation expectations can be a self-fulfilling prophecy. So I think we just need to think about our portfolios this year in terms of what we have that could potentially be inflation hedges. Gold works sometimes, not all the time, historically, but even the fact that you have exposure to dividend-paying stocks can help combat the effects of inflation. And then finally, fiscal pressures. We have to worry about the potential for the 10-year yield to go up. If investors become bond vigilantes, they're not convinced we get government spending under control. And then, of course, we also have to worry about growth headwinds. So in general, I think this is a positive picture, but as with any outlook, we need to think about the potential for alternate scenarios and, of course, the very many swing factors we're seeing this year. We just don't know what the outcome will be, so this is a year to be watching the news and watching our portfolios carefully. So let me stop there.